I think we even thought that the shoe might drop a little bit at the beginning of this year, kind of like what happened in 2016. About there was a market pullback, but I think we are up about 5% this year so far, 4 to 5%. So we're off to a nice year. I think people are still very optimistic about where we are in the economy, what's going to happen with Trump's tax plan now that it's going through. We're starting to get into earnings season, and a lot of these U.S.-based companies are having great earnings. Yeah, I mean, there's still a lot of cash on the sidelines. There's a lot of debate on why that cash is on the sidelines. But we're getting calls from everyone, people that aren't happy with other for their performance that aren't clients. You know, it's kind of 50-50. Some people are very optimistic, and we got a good majority of, hey, we're 9 years into a bull market. You know, it seems like a lot of this tax reform is already priced in or kicked in, and maybe pulling some money back. But you know, I think you always have to look at your time horizon for investing and know, hey, if you're 40, if you're 50, and you still got 20 more years left of savings, that you know you can weather a 5-10% pullback, and it's healthy in the long run. The most brilliant people in the world, a lot of them, like the Howard Marks of Oaktree, have been calling for a pullback for 3 years. And I think you got to know if you're Michael Jordan or not, I guess. You know, we're long-term investors. We're in it for the long haul. Yes, we raise cash sometimes when we think that, you know, the market may be a little bit overvalued. But right now we think that, you know, we're kind of in a sweet spot. Interest rates are still low. Before they rise to let's say around 3%, that's when I think we'll start take some money off the table and going more into bonds. But I think that 3% is a key figure for interest rates. Well, I think market timing is way too difficult. You know, calling tops and bottoms it's just very tough and almost impossible to say. Very few people can do it. And even ones that have done it in the past, that doesn't mean that they can do it in the future. So, you know, we are dollar cost averaging in, we always do, but we do recommend that for your clients for clients as well. Maybe not put that whole $6,500 or $5,500 if you're under 50 into your IRA right away. Maybe do $1,000 a month, you know, or $500 a month to reach that goal. We really like domestic-based companies, small cap and mid cap especially, that do most of their business in the United States. We think that's really important. They'll get the most benefit from the tax break. So we still like tech going forward. It's hard to fight. It's hard to not say tech will do well. The companies consistently beat earnings, and we wait till they start faltering on earnings to really take some money off the table there. The biggest thing for people my age is just to invest. I think it's that simple. Take full advantage of your 401k, take full advantage of your employer match, and don't look at the daily fluctuations of your portfolio. The market's only up 53% of days in the calendar year. So you're going to see down days as much as you're going to see up days, and you don't want to let that affect your psyche towards investing. You know, I think millennials believe in this is kind of another revolution, a technological revolution with the Uber and, you know, the gyroless cars. And I think that's what people think about when they think about investing that are my age, is what's going to happen in the next 20 years. You know, what are the technology, what are the companies that are going to lead us to this next step in, I guess, this evolution of technology. I think it's a little bit of both. I think the Oracles, the IBMs, the Intels of the world have just restarted. They kind of had to, you know, press the restart button in the 2000s and change their business model a little bit and where they're headed and where they're headed for the future. Intel has done a great job of getting involved with driverless cars, and like the NVIDIA struggled for all the 2000s, and now their GPUs are huge into driverless cars. Not only that, but data centers as well. So we like both names, really. There are new companies that are going to drive us to the future, but I think the old blue chip companies are really starting to come around. And companies that have billion-dollar market caps, it's not an overnight thing. It has taken them. They've lagged for 5-10 years now since the 2001 market crash. So it's taken them a while, but I think they're finally starting to become profitable in areas that are going to really lead us into the future. I think it's purely speculation right now, and we really try and stick away from that for clients, because there's just so much unknown. Government could start regulating it. South Korea just started regulating, saying that they aren't going to have Bitcoin and cryptocurrency miners. There's the blockchain that's behind that could have some success in the future with especially overseas transaction and bookkeeping. But as an investor, we try and stay away from things that are that speculative. It's very possible, and I think it's all based on earnings. As long as earnings keep on beating the projections, that I think this could last, hopefully it'll last all year. I think as interest rates rise, people might start taking money off the table and going to bonds. The closer we get to that, I think, 3% mark. But I still think there's areas overseas, emerging markets, Europe, France, with Macron being the new president. I think there's some opportunities overseas as well. So we're starting to bump up our overseas exposure. We had to have a good amount of money in emerging markets, and we're starting to put even more in Europe now.